Okay, welcome to the Air Mirror Trading Group 1 meeting. Today is the 10th of May, 2021. And if you're new, welcome. This is a trading group primarily for option traders, but we do talk about currencies, futures, stocks, pretty much anything you want to trade. If you have any questions, lots of experience in the room. I think if we added up the number of years of investing trading experience everybody's got here would be quite a bit. So welcome everyone. And yeah, let's see. I just wanted to show you one quick chart here. Let's see, where's security? The British pound is having quite the move. Can you see my screen yet?
Yeah, I got it.
Okay, so this is a daily chart. You can see it's the last 2 days it's gone from 138.8 up to 141.37, which for currencies is gigantic. You know, we're up over 1% today. So I think there were some Scottish elections. I'm not sure what's moving it, but you can see there's quite a few of reporting events here.
Back to a pretty important level too.
Yeah. Hey, morning, morning, Andrew. Let me go zoom out a little bit to a weekly or maybe a monthly view. So here's a monthly view. You can see years ago, 2016, it was
this is where the last rally failed. So
yeah.
Is it going to break out of the trading range, or is it going to reverse and stay in the trading range?
Yeah, it's kind of coming up on a key test right here, really. I remember the euro when I was living in Europe. Let's see, yeah, here we go. I remember paying my mortgage when it was up here like 157. It was painful. A lot of volume here, but it's kind of similar chart where it kind of drifted lower, and then now it's kind of had higher. Probably more a story of the U.S. dollar getting weaker versus the other currencies getting stronger.
Now, that 125 was support for a long time, and then it broke through, and now it's trying to decide if it's resistance.
Yeah, it's kind of right bouncing around on this line, isn't it? All right, so I just wanted to make people aware of that in case they're doing any currency stuff. Here's a monthly chart of the ES, kind of crazy.
Brexit is looking better and better all the time.
Oh,
yeah. Anyone see gold lately too?
Yeah, I know gold has been kind of crazy. Let's see. Do I have gold on here? I don't have commodities, maybe. GC, there we go. So here's a daily chart for gold. Let me zoom in a little bit more. It's kind of reminiscent of the pound, isn't it? It's just shooting higher here. Oh, and speaking of gold, for I think I sent an email out to all the Sleepwell subscribers, but there was a bug that people are using the 3x leveraged gold ETF. I think it's UGLDLF or something. I had on my form where you pick it on the allocation editor for the Sleepwell subscribers, was missing the F at the end. So that's fixed. And if you want to try the 3x leveraged gold ETF, it should work now. So that's something I fixed. Let's see. That's basically what I wanted to share. I know Daniel's going to send me an updated XE. I haven't checked my email lately. We had
gold has actually been the laggard among a lot of the commodities. There are so many commodities that have been much stronger.
Let's see.
You know, look at corn or lumber.
Probably the best way is just FinViz. Let's see, futures. I love this chart. It's kind of one-stop shopping for everything. So grains. Let's see which one.
Look at the corn chart.
Corn, where are you here? Corn, there it is. Oh yeah, that's pretty impressive, isn't it?
And lumber.
Lumber. Where are you, lumber? Oh, there it is. Oh, I guess that's why the news article I saw said prices were going up everywhere. Charts like that kind of explain it, don't they?
Yeah, if that doesn't tell you global inflation is active, I don't know what will, right?
Yeah. Wow, that's pretty impressive.
Is that a logarithmic chart too, or is it
It doesn't look like it.
linear? Yeah.
Yeah. So yeah, if you want to get I mean, I kind of take a mini snapshot of some of these for the member homepage, but this is really great, especially middle of the night. You want to see how things are doing without having to open any trading software. Just go to this futures page and it'll give you a quick idea of what's going on. Now this is interesting. Why is the NASDAQ 100 down 1.7% and the S&P is only down not even 1/4%?
The NASDAQ has all the overpriced stocks.
Well, I guess a little correction time.
Well, actually,
Good morning, Dan.
hey, good morning, Tom, and good morning, everybody. This divergence of the NASDAQ is actually somewhat worrisome. As I think I mentioned on the roundtable that Tim and I did, I have gone over to day trading futures and long options on the SPX and boxcars, of course. I have a couple of them, but I don't have any overnight holdings except for those and a little bit of Wayne's stuff. But anyway, I follow Peter Resnicek, the market profile guy, which I use as well. And he noted this morning on his morning report the divergence between the S&P futures and NASDAQ futures, and he regards that as a negative.
This has really been going on all year too.
Yes, it has. Yeah. So, I've gone back about 8 or 10 years ago. I read Dalton's book on market profile, and I'm revisiting that, and I'm using that in my own trading. It's a very useful way of organizing what they call market generated information, MGI, as opposed to, I mean, you get obviously good information on a candlestick chart, but you get additional information if you correlate that with the market profile. So I've been doing a lot of that, and you had a couple of good trades this morning right at the open. But anyway, the point is he regards the divergence as being somewhat ominous.
Yeah, tech stocks like low interest rates, and we've seen interest rates rising for a while.
Yeah, here's the 30-year bond chart. Interesting.
Yeah, you notice the NASDAQ started lagging right when the bonds sold off.
Yeah, so mid to late March. Let's see, let's flip back to NASDAQ. Mid to late March. Yeah, right about, it was a little bit earlier, but yeah, similar.
And you know, the S&P continued to make new highs while the NASDAQ is, you know, lagged badly.
Right. So I wonder, Wayne, are you seeing anything with your macroeconomic indicators that is kind of showing any signs of warning for equity guys?
So yeah, I mean, it's always funny that you ask that. Yeah, I mean, it's
But on your crystal ball, right?
yeah, you know, and you know, it's so right now, as far as our current macros, now things can change, right? You know, because everything's kind of always adapting, especially with the the indicators and calculations that I use. They're constantly changing. But as far as right now, I mean, you know, expectancy for the S&P is still pretty strongly positive. In fact, it's one of the stronger environments for the S&P 500. That doesn't mean that it won't shift or change, but I mean, right now, there's nothing on the horizon that I'm, you know, necessarily freaking out about. There's when we get inflation, right, especially inflation in global currencies, so I don't look at gold as a commodity. I know that that's pretty common to look at gold as a commodity, but I look at gold as a global currency inflator. So, the US dollar can inflate, but that's a little bit different than just raw inflation. And so, anyways, when that's starting to be active, and then at the same time we've got stocks still pushing higher, and we've got strong earnings growth, which that's kind of a little bit weird because it's an annualized thing, and last year it was pretty crap. So there's some strange things going on with the calculations, just because yet last year was so fast to turn around, that anything dynamic is really it's got to make sure that it adapts really fast to last year. So, but anyways, no. I'm not seeing anything kind of crazy on the back end or anything like that. I will say that the risk is starting to shift a little bit, where it used to be that you could just pretty much be pretty strongly powerhouse towards stocks, and now it's starting to look like you want to be a little bit more spread out. That's pretty much what's going on right now as far as my macros go.
Awesome. And I noticed on the just the price updater, I've got I think the gold, and which one was it? RPAR wasn't updating, so I have to fix that. But I've updated this on the sleep well page down here. So this should be current. I just updated this. So you can see it's sleep well's hanging in there. It's not losing, like kind of the big thing, right? Sleep well, you don't worry about the downside so much.
Yeah, we've been, we had a really strong back when it was just purely into inflationary assets, and then we transitioned for a little while into a stronger dollar environment, and we were kind of setting up for that. And then that stronger dollar environment, which we had talked about that, if anyone had read my weekly commentaries and things like that on the assets, like the dollar, it didn't look like it was going to stick around for long, although the models were thinking it was going to stick around for a little bit longer. And that was definitely the other direction. We basically just started, pummeling the US dollar again. And so now we had to flip back to the other environment. So that kind of caught us a little bit off guard, which made us just go a little bit more sideways. We don't necessarily lose when we're wrong, but we're just a little bit more sideways than usual.
Right.
So now we're kind of back on track and flowing with everything else down there. So we'll either outperform or keep up with all the other portfolios.
Yeah, it looks like you're right near the all-time high. So the high value was only like $230 away from where you are right now. So that you can see that on the chart.
Yeah,
It's
we
right
are.
up there.
We are close. So we actually tapped it. We tapped it a couple weeks ago, and then I think we tapped it actually last week. But yeah, I mean, with that, actually, I posted. Well, I posted in our private forum, so I guess I could talk about it here. There was a lot of requests for, like, people wanted to augment the sleep well portfolio. Like, traders are traders, right? We were like, hey, I don't know if I could just sit around and let this thing do its thing, right? Like, I want to see if I can, like, enhance it, or if I want to put my own biases or something like that. And so I had just put together, like, the two common ways that I was like, okay, hey, if I was gonna, want to be a little bit more active with this, I would. And so I can show that. And then one thing that was interesting, which I don't have ready to just kind of show right now, is there's a lot of people that want to mean revert, like the sleep well portfolio, or mean revert assets in general. And some assets actually just don't like to be mean reverted because they trend too long. And the sleep well portfolio is actually one of those. So on a lot of my mean reversion types of methodologies, like I put some like a type of Ballinger band around the sleep well portfolio. I used a moving average above and below. I used a stochastics. I used an adapting stochastics. I mean, all sorts of things. And actually, for the most part, I couldn't increase the return without increasing the drawdown for mean reversion on the sleep well portfolio, just because you just trend too hard. But on that, I can actually show that graph.
Oh yeah.
Here, actually, you probably have it available. I just didn't know. Let's see.
Yeah, I think you can share.
Yeah. So I'll just share it in the forums.
Yep, I
So
see it.
yeah, so this is a forum where people, where we've talked about leveraging and different types of leveraging and things like that, but I'll get to an allocation size thing too. But I had heard, right, through like other people that had talked and types of things like that, like, hey, sleep well portfolio is at a high, right? I'm gonna deleverage, or I'm gonna take some allocation out or something like that. And then when it's at a drawdown, I'm gonna increase. So that's actually what this did. So this red line down here, let me explain all these graphs really quick. So the green line back here that's dashed is like a raw 3x leveraged portfolio of the sleep well portfolio, right? So it does close to about like 22% annualized. And then on that's a CAGR too. That's not an average annual. An average annual will be actually a little bit higher, but and then this dashed line down here that is a little bit more gray. That is an old strategy that I was, when we were originally talking about leveraging, where the more assets that are online, you could leverage up, and the less assets online, you could leverage down. And that was a nice kind of a risk averse way of leveraging if you wanted to leverage up just based. And then the yellow line down here is just 1x, right? That's your typical everyday sleep well portfolio. This is all up to about mid 2020, by the way. So this isn't like pure current. And so this red line is actually what I'm talking about today. And this is where when it gets drawn down, you go from a 1x to a 2x. If it draws down more, you go to a 3x, right? It's in a sense, you're buying dips, nothing astronomical crazy here. We're not, changing trading, right? We're just, as it gets drawn down, you buy the dip. So you can see here, the recoveries are actually quite a bit faster, and I've got a drawdown chart that can show that. But what's really nice about this is it does prove that a lot of the traders that were talking about this, that, hey, when you start buying the dips or when you start doing things, you can really enhance the leverage and actually get almost identical to 3x leverages with 461 weeks at 1x leverage. So there's a lot of time that you're actually not leveraged. You're not taking the leverage risk. And then significantly reduced in 69 at 2x leverage, and then 118 at 3x leverage. So there's an inherent risk aversion way than just a raw 3x leverage. So if we wanted to take a little bit more active of a switching, going from a 1x to a 2x to a 3x leverages, this actually shows this is a decent strategy to do that. So there's two on here. There's the more assets that are online, you could leverage up, and then as the drawdown happens, you can leverage up. One caveat to this is psychologically, you really got to be a trader for this, right? You gotta believe in what you're doing, and being able to put money into something and leverage up on something when it's not working psychologically is pretty hard. I had posted on the forums when the sleep well was drawn down, but probably it was
March 25th, I think.
Yeah, like a few weeks ago or a month ago or something like that, maybe a month and a half ago. And I just put a little graph on there that just showed that it's really rare for us to draw down like around 6% in the sleep well portfolio. And actually, I think that day that I posted it, which is just a fluke thing, it literally bottomed and turned around and just rocketed, and now we're at new highs again, right? So anyways, that's kind of that type of strategy is when it's drawn down, you leverage up type of thing. And the exact code to it is up here, just kind of how you structure it. Anyways, and then, yeah, so you get pretty close to 3x returns, 21.55 CAGR, maximum drawdowns about 17. But it's a really interesting drawdown chart right here. So the red back here is the more active leveraging style when it's drawing down. And you can see for the most part, we actually under draw down the 1x variant. So this is not like the 3x to 3x. This is actually the 1x risk profile back here. The only time is just a couple of these we just wick up just a little bit beyond. Another caveat here is that we're using, past performance to enhance it. So this is, just for all those anti-curve fitters out there and data miners. This is a little bit like, hey, we knew when to leverage, right? We knew that type of thing. So this is, of course, assuming that the risk profile of the sleep well portfolio will retain in the future. And now we've got a very rich, robust data set from here. So, we've got a pandemic, we've got a major economic crash, we've got a debt crisis, we've got volatility explosion. I mean, we've got all sorts of things in this data set, which is pretty nice. Anyways, and then I also just wanted to throw up this last little bit. There was also a whole group of people that were asking, hey, I just don't want to take the full-on risk of the sleep well portfolio, but I'm okay with being a little bit more active. And so I was just showing here that you can actually take the same concept of leveraging and not leverage it, but just allocate size. So instead of doing a 1x, you're only 30% invested and the rest is in cash, or you can throw it in, a bond ladder or a CD or whatever. And then 60% invested when the drawdown happens. And then of course you're 100% leveraged whenever the drawdown max happens. So anyways, that gives you a really, really, really nice, 7% CAGR, which keeps up with the historic S&P, and then with only a 4.8% max drawdown. That is including all of the crashes and COVIDs and everything in here. You can see it, it's very steady Eddie. So that's for the very risk averse. I don't want to leverage, but I just want to allocate size. So yeah, anyways.
So how do you decide when you switch from one mode to the other on that?
Yeah, so I went through and I was just tweaking an algorithm for it, and the points that I came up with, or that the data pointed to, was basically at 1x, which is just high water. So if the portfolio is ever breaking a new high water, so we ever get back up to our highs, you go back to a 1x variant. And then if the drawdown exceeds 4%, so if the portfolio exceeds 4% drawdown from the high water, you 2x leverage it. And then when it exceeds 5% or more, you go up to 3x. So there's not a huge window of 4x, but and then you go up to a 3x at 5. And then you pretty much ride it at the highest leverage until you get back to high water. And so that's what helps these drawdowns. You can see how fast these drawdowns happen, and then they hit high waters when they get down to 0 right here. So that's how fast they get recovered versus the 1x back here in blue, right?
Right.
You can very quickly get to 1x because it's leveraged. And so as soon as the portfolio comes up at all, so it is a mean reversion type trade on it, but it's mean reversion to the downside instead of the upside. So
Hey, Wayne.
yeah, what's up, Dave?
Hey, I got a question.
Sure.
Relating to what Dan Harvey was talking about earlier, in saying that kind of the diversions that we're in right now, and the impending situation that's out there. Where are you now on this? Are you in 1, 2, 3? Where is it like today?
Oh, so the regular portfolio follows a 1x. I don't change anything for those. Now in my own personal account, I'm leveraged, but for the portfolio and the account that I use for tracking the portfolio, that's just 1x variant. But I mean, it would be theoretically if I was following this leverage profile, we technically have not hit the high waters yet on a weekly basis, so we'd still be leveraged up.
Okay.
Because we got drawn down, and we would have been drawn down to 6%, so we would have been 3x leveraged as of a few months ago.
Yeah, I wonder sometimes with the, I think you very aptly put, it's the, you can do, and these are, wonderful charts, and they're really cool.
Mm-hmm.
I'm wondering, is that and especially just to put, thoughts just on paper, which is really neat for people to see.
Mm-hmm.
But I wonder sometimes, is that the, like you absolutely mentioned, it's it's like, okay, here's what you can do, and here's
Mhm,
what everything is showing us now. Psychologically, can you do it?
for sure.
So and it's always a situation where it's like, okay, hey, now we're getting like a nice drawdown, not nice, but we are getting a drawdown, not nice, but opportunity is sitting there to go say, hey, let's go in 3x. But then it's like, oh man, but what's your stomach telling you? Can you do it?
I mean, psychologically, I mean, that's why I kind of threw this caveat out there because
I know.
it's a little bit, so this dashed one, I know it's hard to probably see, but this
Well, you can
dashed
see it.
one, okay, so that one is a little bit more psychologically tailored, right? Because as more assets come online, you're leveraging up, which helps because, hey, you know, thinking about this psychologically, I have more assets that are playing off of each other, right? So it's going to reduce my standard deviation on a daily basis. So, hey, I can risk up a little bit more, you know?
I was thinking just of what Dan was saying earlier, saying, not having things overnight, kind of keeping things
Mhm.
intraday, very, I would say, very one X land as opposed to 2 or 3X land. I was trying to figure out, okay, where is it now? And I think that's that classic confrontation between what's your risk, and how much risk do you really want to take? Are you 30 years old or are you 75 years old?
Well, and $100,000 in a vertical is a totally different animal than $100,000 in a diversified portfolio, right? Like
Mhm.
the probability of losing, or at least just max loss risk, right? In the vertical or an option strategy or something is significantly higher because you can have a black swan wipe you out, right? If you have a 20% drop most of the time for someone that's like selling verticals or something like that, if you've got a 20% drop, you're wiped out. Everything that you have in that trade is gone, right? A 20% drop in the sleep well portfolio, most likely you're diversified, but even if you're not, right? And we're just in whatever asset that vertical was, which is kind of crazy, but say we were, you're still only out 20%, right? There's no craziness. Now, if you're leveraged, right? If you're 3x leveraged or something like that, you got a 20%, you're still not fully wiped out, but boy, that sucks, right?
Yeah, and like you said, on one of your other charts, you showed that sometimes you would have some percentage that would be in versus cash, so you can
Oh yeah,
diversify
this one.
there too.
Right, right. Yeah, I mean, that's something to kind of keep note here is that for 461 weeks out of this total back here, you're at 30% position sized. I mean, that's nothing, right? I mean, most of the time you're sitting on 70% pile of cash with only 30% invested. And it's really only in some of these volatile moments, and especially volatile for the portfolio, that you really get a little bit more. So the volatility actually gives us a little bit of um, opportunity to take,
Yeah,
right?
you've got the way I would look at this is that you've got different levers, and you got levers for 1x, 2x, 3x. You got
Mhm.
another parallel lever, if you want to call it, for percentages that you can be in, whether how much of a percent that you're invested versus cash or whatever. So,
Yeah.
and you can fine tune those based upon, how you are, put in all your components, your age, your your level of risk. You kind of go down the line, which I think is really cool to be able to kind of do that.
Yeah, and risk, I mean, we could have probably 5 roundtables on risk, honestly. It's one of those things that everyone measures it a little bit differently. Like for instance, for
Absolutely.
me, I'm younger, exactly like what you said. My time horizon is a little bit differently. So leveraging isn't really a big deal for me. Uh, so but at the same time, I also look at, hey, okay, this is my strategy. This is how much data I've got. This is how much I'm willing to risk. Can I handle that number? Like, so for instance, if I've got a drawdown, so let's take this 3x drawdown, for instance. So I've got a drawdown of 17.7%, right? So that's what its maximum hit. Let's give us a little bit of buffer. Let's say like a 19% max drawdown, right? If I've got $100,000, or even like here, let's go with a smaller account, right? If I've got $10,000 and I'm running this strategy, right? And I say, okay, 19% off the top there. If I go, let's just round it to 20%, right? If I can't handle an $8,000 account size, right? Knowing that I dropped $2,000 off the top, if I can't handle that and still stick with the strategy, like that unfazes me, then I need to position size smaller, right? That's just kind of how it is. And what's unfortunate about that most of the time that I've noticed is, even though, yeah, we've got a position size smaller, a lot of people don't want to do that because they want the return, right? They want the higher return. But then what ends up happening is the drawdown inevitably comes, because it always does, and then they strategy jump. That's
Yeah, all of the things that you're mentioning right here are, I know probably as far as Dan probably years ago, and Tim and myself more lately, when personally mentoring people. These are such classic conversations to have with people that that are really good. I mean, it's the folks that don't really have the conversation, just kind of go off willy-nilly and kind of do it and then just get nailed. But to be able to, you provide really good information here for people to then be able to go make a really good sound decision.
Oh, and I see there's a couple of comments in the chat. Curtis asks, can't read the fine print descriptions of what line is which.
Oh, yeah. So going through this, blue line is SPY, yellow line is a 1x sleep well portfolio, dashed gray line is when we have three or more assets online, we 2x leverage. When we have 4 or more assets online, we 3x leverage. The green dashed line is the raw 3x sleep well portfolio. And then the red line is the buying the dips strategy, where you leverage up as you go into drawdowns. And then, yeah, and then as far as just to clarify, like 1x and 2x and 3x, there's always quite a bit of questions about this. You can't leverage every single one. And it doesn't always benefit you to leverage every single asset that's in the sleep well portfolio. So anyone that's not familiar with the sleep well portfolio, we run 6 assets in it, and we change allocation size to each one of them dynamically based on macros. But the 1x variant is really simple. It's just 1x across all of them. The 2x is your 2x on SPY, and then SPY, gold, bonds, and the Russell, or the IWM. And then when you go to 3x, you only 3x the equity versions. You don't
kind of the decoder, the way those are, there's the 6 ETFs, and from left to right, SPY, TLT, GLD, UUP, IWM, EEM. So those are what you're referring to on that 11111 222. So
right.
Maybe just put that above there for people who aren't familiar with it.
Yeah, I could probably do that. If you're familiar with the sleep well portfolio and how the assets are always lined up, that's just how we always line up the assets. And
oh, just for people who may be watching the recording and not familiar.
For sure, absolutely.
And then Nathan says, Wayne, just so I'm clear on the terminology, is the high watermark an all-time high for the asset?
Is for the portfolio, yes. It's an all-time high for the portfolio, yes. Not necessarily a particular asset. And I might have, Dave, when you asked the question originally, I don't know if I clarified this or anything like that, because I actually do think that we'd be less leveraged now that I think about it. So what this strategy does is, and I kind of just went into explaining it right here, but the high water mark, all the drawdowns are calculated from just a 1x portfolio, not from the leverage portfolio, although it does work that way too. And then the trade only goes back to a 1x variant when the high water is breached, but it's the high water of the actual portfolio that's already leveraged, not the 1x. So the 1x will take a little bit more time to get back to high water, right? So you can see this in the blue. It takes longer to get back up to high water. How the code is written in this is actually the instant that this portfolio gets back up to higher water, which would be right here, that's when we would unleverage again. and then we would wait, and then we'd get drawn down again. We'd probably leverage up again right here, and then we'd come back, and then we'd unleverage. So that's kind of how this works.
And
As-
another question for you, Wayne. I had a couple people ask, do you have the back tested gain and drawdown statistics for the 2 and 3x portfolios since it started?
Yes, absolutely. I definitely have it for this data set, like outright. It's actually on the Excel spreadsheet that's in the forums. And then I have it for the total as well, and I can always post that. I think, Tom, I'm actually going to give you those stats, so we can probably put it on the
Information page, yeah.
Right. So then we could just post that, or maybe we can have it as a rolling calculator or something. I don't know. So we'll figure that one out. And then there's something that it's just kind of an idea. We haven't even really thrown it around, Tom. So not to like throw you on the, on the, not to like just, kind of throw this
Put me on the
you, right?
spot. Yeah.
Yeah, but I'm totally putting you on the spot right now. But the idea, or like there was a thought of like, hey, what if I wanted to be this more active, right? But yet I didn't want to have to try to track all this and everything. It's super complicated. Maybe like, as a premium to the service or something like that, we can sit there and say, hey, here's an enhanced tracker of like saying, okay, hey, I want to run these types of leverage levels, or I want to run this types of allocation levels, and just have the software, like when you log on or something like that, basically tell you what to do this week, something like that, or
Right.
tell what the strategy should do this week. Never to tell you what to do, because you make your decisions, but
Right.
you know what I
Based on these criteria, here's what it's saying to do.
Right.
And you would decide if you want to do it or not.
Yeah, I think that would be really cool, just so that each individual person, wouldn't have to track this or something like that.
Right. Yeah, I do have plans for adding the ability to track multiple portfolios as a Sleepwell subscriber. I have to get around to it. I've got so many other things going on. So
Oh, you're a busy man, I know.
never a dull moment.
Maybe I'll hire a programmer to come in and help out,
Well, I don't know. We'll see. I think I can probably do it.
Can't let anyone in on this, right?
Well, it'd be a lot of learning curve for whoever would do it, but
Oh, I'm
yeah.
sure. Yeah. So anyways, that was all that I kind of wanted to go over, just because there was a lot of people that had asked about this. So
Very
I
cool.
can stop sharing and leave it to someone else now.
Yeah, appreciate it.
Hey, Wayne, just as a final note on that one, I just think it's really neat how you're able to, where people are requesting stuff, to be able to put stuff in there so that you're giving people lots of choices and options, which I think, was my only really message. Was it's really nice that you're giving people what they want, and also, choices so that they can make their own decisions, which I just think is great.
Oh, thanks, Dave. I really appreciate that.
And Dave, we're doing a roundtable tomorrow morning. You want to have any sneak preview stuff for people?
Well, if you want to see my PowerPoint presentation, Tom, it would be really, really slim at this point because I have a lot of work to do today.
Well, I don't need to see a PowerPoint. Just maybe just talk about high level kind of stuff you want to go over.
Yeah. Just really, really briefly, because we're doing a roundtable at my normal time that I usually have with my group tomorrow morning at 8 o'clock Pacific time. And basically, it's kind of a culmination of kind of a revised Dreamlifter trade, which we stopped trading back around mid-December when we started, things started to really change as far as the market. And what I did is that I think, Tom, you had kind of coined it the other day. It was kind of like the Goldilocks trade, so to speak, where
Right.
you got a Dreamlifter that's sitting out there at 80 DTE, and we got a flex trade that's 4 or 5 DTE, and and comments that I was getting from subscribers was from some people was some of it feel the people it was just too long, some was too short, so maybe we need one just right. So what I'm doing is kind of introducing a revised Dreamlifter, which would basically be incorporating, as I say, kind of as I used to use the term back in my manufacturing days, kind of best practices or best manufacturing practices, or I could say maybe best trading practices or trade design practices, in coming up with a trade kind of in the middle. Okay, something that is, the returns are not as fast as a flex would be, but not as, you don't have as Wayne was just saying, you have the potential of more more risk, more drawdowns with the faster trades than you do with the longer trades. So it's trying to come up with something kind of in the middle. And I guess one of the really cool things, which I can't wait to show people tomorrow, was taking a Dreamlifter from, basically I'm changing it from about 80 days and cutting it in half, basically to 40. Okay, so that's kind of one of the main things. Okay, but incorporating with that is taking kind of, as I say, the best things that we had from the 80-day trade and the back testing I did over 10 years, as far as that's concerned, plus all the live testing and the live trading that we've been doing with the flex trade since December, and taking some of the, like I say, the best points of both and putting those into a trade so that there is some overlap between them. And the back testing so far, I actually went back through and said, okay, if I would have just done the Dreamlifter 40 days back when we started it back the end of June of 2020, how does that compare? And I'll be able to show all that tomorrow. And I think people will see that it's significantly different. And I'll run through, at least one trade example, or at least maybe one or two, depending upon time, to see how it kind of works out. And it's so made I think some good revisions. It's not like a completely new trade. It's more of just, it's a revised trade, and looking at trying to, the consistency was amazing as far as the profitability, as far as month to month, because you were able to, it's kind of like when you get into a little bit of trouble with the 80-day, what I saw was that, through everything that I've been taught over the years, originally from Dan, way back, gosh, what, 11, 12 years ago, was, if you're having trouble with a trade, what do? Go back and really dive deep into it and find the Achilles heel and find out what's happening, what's different, is the market different? Is the trading time that you were in different than what all the back testing that you did, and try to figure it out. And that's what I did, is I went back through and did that and found some holes. And so was able to, plug those up with some other best practices. And I'm very excited about it. And we will be actually putting on right after the session. Hopefully, if there's people that want to join up, I will be putting on the first Dreamlifter trade, probably just after the session tomorrow, or towards the end of the trading day tomorrow. So I think that would be kind of cool, that if people want to join in, there will be the opportunity after they kind of see what I have to say tomorrow morning.
Looking forward to seeing it, and hope you get that PowerPoint fleshed out. I'm sure you
Well,
will.
I think, and to be honest, Tom, and I know that it's I'm not going to go crazy on the PowerPoint, because I think from also comments that I've heard from people is that less PowerPoints and more walking through a trade is nice. So to be able to, it's more educational, and to be able to understand it better, as opposed to just, I'll definitely have some statistics and I'll put up some things to be able to show in general and summary. But I think what people really, really want to see is, let's get into the detail. Let's walk through a trade and find out, what are the things that are changing here, and how things are different, and how things can be different in the trade. So I'm going to concentrate more on that more than anything tomorrow. So hopefully that's what, again, like what Wayne's doing, we're trying to provide what people are asking for.
Yeah.
Sure.
Hey, David, I know. I've actually, I'm a little bit closer to, for all of you, we live in the same town, Dave, but, and I know you've done a ton of work and everything like that. So, and I'm a little bit closer to it, but what would you say is the main, thing that like really kind of triggered you to go from the old Dreamlifter to this Dreamlifter?
Yeah, great question, Wayne. The main thing was when I actually went back through the trade analysis, and we kind of call it doing a post-mortem on a trade, when it didn't go well. So it's like, okay, let's go through and analyze what didn't go well. And I found a pattern. And the pattern that I found was that if you're sitting out there at whatever time frame you're at, 60 days, 70 days, 80 days, whatever the time frame is, if the market condition is such where we have significant moves on a few days, and then the market just sits there. So we could be sitting, you enter a trade, and then all of a sudden the RUD or the SPX goes up, 30, 40, 50 points the next day. And maybe for the next day and the next day. So all of a sudden you have a situation where you're way, way, way out, from a tent standpoint, you're way off to the right. And most people would, at least a lot of the training was, we'll probably have a mean reversion. Well, in many cases there, we did not. Okay. And those were the cases where if you didn't go and be a little bit more aggressive as to recognize what has happened and get a little more aggressive as far as, going and trying to be a little bit closer to where the market has moved, but also then being able to put in some very special, rules to make sure that, you don't get caught either. That in and of itself was one of the main Achilles heel that I saw with my prior Dreamlifter, where in normal market, I looked at it for 10 years, and very rarely did you have a market condition where you actually went and you had these significant market moves. I'm talking, with the SPX and the RUD, combination of, 100, 150 point moves within just a few days, and then it just sits there. And that in and of itself, it's kind of like watching, paint dry after a while. And you're just kind of like waiting for something to happen. And because you're always fearful that, oh my gosh, if we've gone up this fast, we're going to probably come down that fast. And, over those time periods, that just didn't happen. And so if I was to answer your question very, directly, Wayne, that's one of the main Achilles heel that I found. And I can show you tomorrow during the walking through trade examples how I handled it and how it all turned out.
It's just brilliant. I mean, I love your adaptability, and just that's one thing that I have to say with you, Dave, is just watching you, like when something's going on. I mean, you are constantly adapting. Like, we sometimes make like self-adapting algorithms and stuff like that, and there's just nothing compared to someone, especially just that's got the experience like you did, just adapting always and just making things better. It's really cool to watch it. So I'm excited for tomorrow.
Yeah, well, me too. And like I said, thanks, Wayne. And I think that it's, one of the things as, Tom and I were having a discussion about, just, what my experience had been and stuff like that. And, one of the things is that I said is that, one of the things that I always wanted to have during my various training sessions I had, many years earlier. One of the things that I felt was always something that I kind of yearned for was, you're always looking to like, oh, how are they doing this trade? And, what are they thinking? And you're always trying to the best thing I could try to do. I remember years ago when I was very much just starting with Dan, was I used to have sessions with him, and it'd be like, okay, if I can just think of what Dan may be thinking, if I ask him a question and if I know what the answer is already and it's the same as what he's thinking, I know I'm improving. And so from that standpoint, always trying to think like that, of trying to be able to improve upon what's going on, I think is a really good thing as far as your own, educational level and your own, I guess, want for trying to look at different things and trying to keep improving upon what you're doing. And to have that kind of built in from many years ago, and that probably comes not only from options trading, but just, I guess, being, just in my work, being an engineer and all that kind of good stuff. But you're always, not satisfied with what's happening. You always want to try to improve things. And, all of a sudden when you get a loss, it's like, oh, geez, well, now we really need to do this. One of the things that I was very careful, though, was not to just say, oh, okay, well, here's a solution to just fix that problem. Well, that's great, but how about if we go back to a normal time frame? Okay, that's what I've built into this, is the adaptability, so that depending upon what the market is doing, we then have the ability to adapt. Whereas with the 80 DTE Dreamlifter, we did not. It was basically, it was one way, and that was it. There was one set of rules, And now we have the ability to have more variability within that to actually adapt, but doing it within a time frame that is not as you're not doing it 4 to 5 DTE. In the trade, it starts off at 40, and the typical trade would probably last about 3 weeks. Okay, so about 20 days. So in the back testing that I did, the average time in trade was about 22 days or so, starting at about 40. Okay, so we're not purposely driving this thing into close to expiration as we do with the flex trade. Are there times that some could get a little bit closer? Yes. Okay, depending upon how the trades do. So anyway,
Yes, kind of digging back into that little psychology right there with Dave, and I know you've mentored quite a bit of people. So how many times have you seen like where after a loss or something like that, or just after a rough period that maybe someone doesn't strategy hop or, quote unquote, jump to a different strategy, but they change their strategy so drastically that it completely changes everything but they don't pay attention to necessarily everything that you're kind of talking about. So they fix that one thing that just happened, but the odds of that ever happening again are so astronomical or in the exact same way that they kind of screw everything else up and end up blowing up. I mean, have you seen those types of things?
Yeah, I mean, typically with that, I would say that that's a kind of a short-term solution, but you're not learning. You're not building in any education to yourself to be able to say, okay, I can falsely go in and say, oh yeah, well, gee, I think I fixed this one issue. It's kind of like going back testing and not doing it with a set of rules and keep changing things while you're doing back testing, which I know some people will do just to create better results. Okay. It's not the way I was taught, but I've had to constantly remind people in back testing mode about being careful about that and don't form fit and doing all these things. And so you can problem solve for a solution for something short term, as you were mentioning, but if you're not really learning, you're not really solving the problem. You're not solving a long-term problem. You're solving just a very short-term blip. And many people that are in teaching mode will tell you is that it's kind of the classic trade hopping. Oh, this one lost. Okay, just move over to a different one. Okay, but never knowing why and what you're doing. And
was it a risk tolerance thing? Was it a fundamental thing? Was it that was just the trade that was, or what, how it's amazing how often that happens, and you're totally right. So like,
yeah, in my mind, you need to spend what usually is lacking is people willing to spend the amount of time necessary to go in and truly analyze it.
And just see, okay, hey, am I okay with this risk, or do I like the way this trade functions, right? And actually, so something like you brought up earlier, which is always is just, even with the strategy that I was talking to earlier about leveraging up sleep well portfolio and drawdowns, is like, yeah, the data looks nice, right? But can you do it, right? Like, is in that moment when everything looks horrible and you're losing money, can you leverage up? Right.
Exactly.
And
it's a gut check.
Yeah. Well, and psychologically, what I've seen more often than not. So I feel like almost everyone can ostrich, right? And what I mean by ostrich is like, hey, things are down, I'm just not going to look at it, right? I feel like almost all of us can ostrich, right? The catch is that when the strategy comes back to high water, that's actually when I see most people cave. Is like, oh, I'm done with this now. I'm going to something else. I just can't handle, and then they jump to something else, and then it goes through a draw, and then it's just this constant thing. So they never actually get the profits of the strategy. They just only get the drawdowns and the pain. It's like, oh man, that's kind of backwards, right?
So agreed.
Hey Dave, it's Curtis Allen.
Hey Curtis, how are you?
Hi guys. I want to say that I didn't get any consistency and real confidence in the market until I stopped doing trades over 30 days. If I'm doing 4 trades a month, average 5 or 6 days in trade.
Mhm.
And, you know, that way, if I lose one, I don't lose a whole month or a whole 2 days, you know, or 80 days, or even 20 days. You know, you
Mhm.
say your time in trade is 20 days. But I've got 4 trades, you know, and I'm doing one in Russell and one in SPX. So I basically got 8 trades. I don't ever have 2 SPX trades on at the same time. I don't ever have 2 RET trades on at the same time, you know, to overlap things to, you know, because I still am sort of a proletarian, and I think of making money in 30-day blocks, you know.
Mhm.
Can I pay the mortgage? Can I pay the light
Exactly.
bill? So, you know, just to put in a plug for that, you know, I encourage people, if they're back testing, to also explore shorter term things, because even if you're doing exhaustive back tests and redesigning your trade, you're still dealing with a finite data set. It's the same data that you used the last time you back tested the strategy. So, you know, the weakness for most of us is that we are going back and curve fitting a solution to a problem that may not happen again. You know, do you understand what I'm saying?
Oh,
That this
totally.
data is not infinitely variable. It's the data that you're creating the fix in your strategy for is the same data that you used the last time you looked at this.
Yeah, and that's why I think it's really critical to be able to have the ability to not only look back to learn, but just to truly understand, okay, what's the basis of the issue?
Right,
And
evaluate it.
right.
Sometimes the basis of the issue is you're in the trade too damn long, you know, and
Yeah.
you look at it and you go, well, I'm a couple grand underwater, but in 3 weeks I will be above. I'll get out of this thing because
Right.
it'll be at break even. And you know, maybe you get it or maybe you don't. And
that's why, Curtis, I'll mention it right here, because this is a good point to tell people, is that with the original Dreamlifter, which was at 80 days, we had a $2,500 profit goal that we were looking for.
Yeah.
With the new one, it drops it down to 1,000.
Yeah.
And so, just to your point, is that what I found also was the ability to be able to go and, you know, as they would say, you know, get more times up to bat.
Sure.
And what I found is that the consistency was significantly better by actually making less on each, but overall more on the whole.
Yeah,
And
which is
more trades.
the same argument really with shorter term trades.
Right, and that's what I found with the flex trade was that, you know, there was certain people that they love the idea of having trades that were, you know, 3 to 5 days, and you know they're all over it. But then there was also some people that said, whoa, this is way too fast. So you know, so there's, you know, so you got different people out there that are looking to different things, and so, you know, I'm trying to provide, you know, a couple different, because I trade both, so it's like, because I like both, and so I like to live in both kind of time frames. So.
On
Yeah,
frequency,
you guys always had a much greater ability to be in multiple trades too. I could never split my attention, you know, and have 3 different expirations of SPX trades on at the same time. That was really tough for me. And I think it's because you're a lot smarter than I am, honestly. You know, and you know, your
I very
engineering
much doubt that.
background. You know, you have an engineering background, and you and people like you and Tim. I mean, Tim not only trades complex trades long term, but he trades them in multiple accounts. I mean, to me, that is a gigantic intellect to be able to do that. I'm really impressed by that, but I also know my limits. And you know, one problem with John Locke's strategies was that I could never come up to his level of work ethic and, you know, going back and redoing the entire trade from beginning to end with the entire data set back to, you know, 2003 or something.
Well,
I just didn't have the capacity.
One thing I can tell you, Curtis, very distinctly was that, you know, for the last 13 years that I've been doing this, what I have found was, as my education has continued, what I found was that the amount of trades and the amount of expiration cycles and whatever has reduced significantly. Okay. So maybe it's because I'm getting older too, but the ability, like you were saying, the ability to trade in multiple, indexes, multiple expirations, whatever. I actually, right now, I mean, I trade in 2 indexes and maybe, maximum of 3 trades on at a time. But,
Yeah. Yeah.
there is no more than that. Okay. Whereas I know that a lot of other people have, you know, 30, 40, 50 trades on, but they're not as complex maybe. But as far as these kinds of trades, I don't do, and I hear you. I can't, what I found is that if I have too many trades on with too many expiration cycles, I can't sleep at night.
Yeah, my mental desktop shrinks, every year.
Yeah,
And
no, I hear you. And
it's like
I'm right
with
there with you.
Wayne's strategy, as brilliant as Wayne's strategies are, if you start 2xing and 3xing the risk, they're not sleep well portfolios anymore. They're just risk, much higher risk. And you can go 30% on a 3x, but boy, when you get hit, man, it hurts. And Wayne is very clear about that.
Active trading, yes. Hey, look, there's more risk to things. That's why, yeah, definitely I always look at the other side first, exactly like what you said, Curtis. Look at the risk first. Can I handle that? Okay, now what's the return for that? Is it worth, is the juice worth the squeeze, right?
Yeah.
So,
yeah.
And yeah, Kurt, what you're talking about with frequency is, absolutely hands down true. Like, if you've got a strategy that's a little bit of a longer term strategy, maybe look at it as the trade is a 1-year strategy. So every year, right, I make 8% for risking, 10% or something like that. But then if you need the frequency jumped up because you either want more money or because it's just hard to be drawn down for so long or something like that, then having faster frequencies is the way to go. And that's just tuning to your personality. And Curtis, that's awesome that you knew that enough about yourself that, hey, this is the frequency, right? That works best for my psychology. That's always
and I think the sleep well portfolio is the strongest when you do consider it a 1-year strategy, and then a 2-year strategy and a 5-year strategy. I'm definitely in the Mike Tyson school. Having a plan is great until you get punched in the face. I've been punched in the face a lot of times in this business, and I am the most gun shy, conservative, humble trader you could imagine now, because I have been through the ringer. I've put myself through it so many times.
I know, like Scott Rubel over at Strategon, he was a market maker, and he has tons of trades on, but he'll typically put a trade on, it'll make some money, he'll spread off the risk and leave it on with maybe like a butterfly kind of shape where he might pin extra profits, but he'll basically move on. He'll just let it sit there and just forget about it and focus on other things. But he'll have 5, 10, 15 trades on, but most of them, the risk of them has been spread off. He doesn't have to worry about them.
Yeah, that's the Tom Sosnoff thing. We never really understood that back in the day. Back in 2006 when I went to my first Dan Sheridan seminar, up in Chicago, Sosnoff was there, and he had 30 trades on.
Yep.
One lot. Amazing.
All right, guys, we're just over an hour, but really good discussion. Appreciate everyone's comments. At roundtable tomorrow, I'm sure we'll all be interested to see how Dave's adapted and changed the Dreamlifter going forward. So that'll be fun. And yeah, thanks again. Really great discussions. I did want to mention one thing. Let's see. Mark Ansel was busy with doing his homework, but he just wanted me to say that Night Owls called the correct market direction last week on all 5 calls, 3 euro, 2 crude, plus a correction direction today on the euro play. So that was his news, but he didn't really have time to talk about it. So I just wanted to point that out. And also, Tim has officially taken over the boxcar trade. So people have been signing up and joining Tim. So Tim, I think, have you started on Friday? Did you put a trade on yet?
Yeah, I had to put on my first trade on Friday last week.
Okay, I know I had somebody ask me, they signed up on the weekends, it was kind of late. Should they paper trade or should they try and get in now? What do you think?
Well, it's within the DTE window that we could accept, so it's possible. You have to look at the strikes and the
If the market hasn't moved too much from your entry point, I would think it would probably be okay to enter.
yeah, I would have to do all the analysis.
Or
But,
just do the first one as a paper trade, either one.
yeah.
Yeah. All right, so congratulations, Tim, on taking that over. I think the handoff is complete, so good luck. And I know Gary's been working on the B tool. I'm not sure when it'll be ready for everyone to use it, but I think it must be getting closer.
Well, we're having email almost every day about that, and we're tuning it up, I guess you might say. We're doing some formatting. We're still tweaking some of the parameters that he measures and how they should be measured, and
Right.
tweaking what various possible trades that it should look at.
I think I have to do a little bit of work on the back end to support it, but it shouldn't take too long. So
Yeah.
that should be coming pretty soon. I don't know if it'll be in the next week, maybe 2 weeks, but sounds like when I was playing violin in the orchestra, we always joked about the first piece we always played was that Chinese one, Tuning. So we're always warming up right now. So
Yeah, I'd say within 2 weeks, probably for sure. Within a week, maybe. I don't know.
right. All right. Well, sounds good. Lots of updates, and look forward to you tomorrow, Dave. And
Thanks, Tom.
and
We'll
we'll
see you
get those
tomorrow.
all. Yep, exactly. And we'll see everybody next week for Trading Group 1. So thanks, everyone. Have a great week trading, and we'll see you next time.